Corporate finance practice problem using Onenote. Exercise warrant gain versus common stock gain. Get ready. It's time to take our chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 1928 Exercise Warrant Gain versus Common Stock Gain tab. Also note, when using Onenote, look at the Immersive Reader tool. Our presentations will also be down in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, and the calculations will be on the side and on down below. We're looking at our warrants once again, thinking about our situation where we're going to exercise the warrant in the future and compare and contrast the gain that might be related to the warrant versus a gain that possibly could have happened if we purchased the stock instead. So here's the scenario. We have the warrants purchased. The number of warrants are 75. They were purchased a year in the past. The cost per warrant, it costs us $28 to purchase a warrant. The exercise price, meaning the price that we can then purchase the stock for if we exercise the warrant, is $35, and we get 2 shares, or we can exercise 1 warrant and get 2 shares at the exercise price of $35. The market price is $48 compared to the $35. So if we had the warrant, we could then, of course, exercise them and get that lesser price. But if we buy the warrant at this point, we got to pay the $28 for it. Then we're going to assume that the warrants expire today, a year later. We would like to exercise the warrant. So we're going to exercise the warrant. No speculative premium left. So meaning there's no speculative premium on the warrant. So that means that basically the intrinsic value of the warrant is going to be the warrant value. And then the current stock price is going to be $58, meaning it went up a year later from the $48 it was previously at. So let's take a look at this. We're going to say the intrinsic value then is going to be, this is the intrinsic value at the starting point of the warrants. The market price at that time is $48 compared to the exercise price, which is $35. So the difference between the two means we get a $13 benefit if we were simply to exercise the warrant, and we get 2 of the warrants. We get 2 stocks, so we can exercise the warrant and get 2 stocks. So that would be the 13 times 2 would give us our intrinsic value then at the $26. So $26 intrinsic value. And then we have the speculative premium. We have the cost per warrant is $28, and we're getting an intrinsic value of $26. So the speculative premium, we're paying $2 in essence over if we were to simply purchase the warrant and exercise them at that point in time. But we're going to wait till a year later here, and then a year later we have this scenario. And let's think about the stock. What if we basically had the stock and we purchased it and then sold it a year later, and then we'll compare that to the exercising of the warrant. So if we have the stock, we have a straightforward calculation. We have the investment amount, which is going to be the $2,100 calculated as, pulling out the trusty calculator. We're comparing the same amount that we bought the warrants for. So we bought 75 warrants, and the cost per the warrant was $28. So that's going to be our $2,100 if we were to have bought the stocks for that at a cost and just bought them outright at $48, the market price of the stock. Then we would got the number of shares. It's not even, so we'll have to work with an uneven number, but divided by 48, we got the 43.75 shares, 44 shares about. The sales price per share at the end of this, 1 year later, is 58, so it went up. The share price went up. So we in the market, comparing that to the cost, the difference between the 58 and the 48 being our $10 gain on a per share basis, we have about 44 shares. So if we take that times the $10 gain, we would then have the $437.50 in terms of the profit on a dollar amount basis. Let's think about the rate of return on the profit. For the rate, the profit if invested in the stock is the $437.50. We have the investment amount, which we put in the $2,100. That gives us a percent rate of return, which is going to be equal to the 437.5 divided by the investment 2100. Moving the decimal 2 places over, that's about 20.83%. Let's think about the warrants then, on the other hand. If we think about the warrants, we're going to say that we purchased the number of warrants, 75 warrants, and the cost per warrant was $28. Therefore, the cost, once again, is that $2,100 that we're now thinking we put into the warrants. Then we're going to exercise the warrants a year later. So when we exercise the warrants, we have the number of warrants is 75. The shares per warrant are 2, meaning we had 75 warrants. We get 2 shares for each warrant so that we can exercise. So the 75 times 2 is 150 shares that we would then have after exercising the warrant. The current stock price, we're going to say, is that 58 minus the exercise price of 35, which is basically the value of the warrant. So the 58 minus the 35 is going to give us that difference of the $23. We got a $23 benefit in essence for each basically share of stock we got to purchase at the discounted price, which is 150 shares. So the 23 times the 150 would give us the 3,450, basically the exercise value, the benefit that we would be getting. Now let's consider the gain. So if we consider the gain, we have the exercise value, the benefit, and then we have the cost. The cost was that $2,100, the $2,100 we spent to get the warrants. The difference between the two, $1,350. Now note, just in terms of a dollar gain, if I compare that $1,350 to the dollar gain if we had invested in the stocks, you can see it's significantly larger than the stocks, and that's because of that leveraging kind of effect with regards to the warrant. Notice we looked at a prior presentation where we kind of compared buying one stock versus one warrant, and it's less easy. You can't really see that kind of impact in that scenario because, of course, the stock price purchase is going to be higher, more money down than on the warrant. So, but in this scenario, we're taking a look at a situation where we put the investment amount the same for the stocks and the warrants, and then we purchased a different number of stocks and warrants. And in that way, you can see even with the dollar amount, this kind of effect of the leverage on the dollar amount. If there's an increase in essence, then you see a bigger gain with regards to the warrants than with the stocks. And then we can do the same kind of thing, comparing that to the warrant investment to get the percentage gain. So if we take that 1350 divided by the 2100, we get about 64.29%. And again, now we can see the 64.29 being greater than substantially the return if we were to invest that same amount in the stock and we had the same kind of increase in the stock price. So once again, you kind of want to see this with the different scenarios. If you were to match one stock versus one warrant, it could be a little bit more confusing, which of course is the reason why we use the percentage method here, because that'll give us that percentage gain. And then in this case, of course, again, we evened out the investment amount, making then the number of warrants and stocks being different to match the same kind of dollar amount of investment. And then you could see basically this being reflected in the dollar amount as well as the rate of the return.